Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about a conversation I've been having with clients that's changed a little bit just in the last couple of years. And that conversation related to legacy or estate planning. So my experience with our client families, at least historically, is that when we talk about legacy or estate planning, providing gifting, particularly for grandchildren and children, although it's a nice to do for many of them, I don't think it's a super high priority for a lot of our client families. Typically what they say to me is, Shaun, we worked hard to provide educational opportunities for our kids, for university, trade school, post-secondary education. We tried our very best to give experiences to our kids, sports and music, and just giving them the best home we could. That's the legacy that we provided, and we think that that legacy has set them up to be successful in their futures. And so they feel that all that foundational planning that they did for their kids has set them up to be successful. Now, I would agree that that's probably one of the best ways that you can provide legacy for your kids, and I suspect that you probably feel the same way. But what I've begun to experience with folks is that's changing a little bit. In other words, there seems to be a little bit of a theme coming to the conversations, which is, I'm not sure that the experiences that we had as, baby boomers coming through our education and starting work and then the opportunity that was ahead for us is going to be the same for our young adult kids. And that maybe we should plan for legacy to give them a bit of a buffer or help, because when we look at the geopolitical events, we look at what happened with COVID, it just seems to have put in place a bit of a sensitivity around this issue in the planning. So what we're going to do today is we're going to talk about trying to balance off the one priority, which has historically been client families want to spend their money on lifestyle and experiences. They gave their kids legacy through their raising up years. Now they're trying to find a balance between still doing the things they want to do in a lifestyle as you transition into retirement, but also provide some maybe legacy planning for their kids and their grandchildren. So we're going to talk about 3 quick little tips you may want to consider when looking at this topic. Now, if you're new to our channel, make sure you hit subscribe so you don't miss future content. And again, in the show notes, there's some helpful links to various resources that you can access. Okay, let's take a look at those 3 areas that might help to provide you with both your cake and to be able to eat it too when it comes to legacy planning. Okay, so the first tip in this area is really kind of boring and ho-hum, but I think it's a really important exercise to go through, and that is, have you updated your financial plan lately? And have you integrated your financial planning and your cash flow planning with your legacy planning? So if you want to get some clarity on this issue, there's no better way than to either do it yourself or sit down with a financial advisor to map out your priorities from a cash flow standpoint, to build your net worth statement and begin to do some forecasting based on your expenditure levels, your tax position, investment returns, and inflation rates as an example, and begin forecasting out how your assets are going to be impacted on various levels of expenditure trends. That will give you a glimpse as to whether the potential for legacy for your kids or grandchildren is a potential. And that's driven often by not just the expenditures, but also some of the assumptions about return and the growth of financial assets or real estate assets over time. So let me just give you an example here. We've got on the screen here Sam and Sally Sample. A bunch of numbers here we plotted for them, but the big idea here is when we do a forecast, we're plotting after-tax expenses, which is the blue here. So the clients are spending money on an after-tax basis for lifestyle. And then when you do that, we can model how the net worth position is going to change over time. And Sam and Sally do have some legacy value over time that they'll pass on to their children. So if you're interested in getting confirmation using some budgeting and cash flow planning, there's a link in the show notes for this video. It'll take you back to our website where you can find out how you can get a complimentary forecast. What we do is we just do a quick run through of the analysis for you based on your current planning. Are you tracking in the right direction? And if there's some gaps in the planning, or if you're not creating legacy, then we can explore in a follow-up discussion how you could do that. So that's the first step, is make sure you've got a financial plan linked to your budget. Begin modeling what you would need to be doing in your planning to create the possibility of legacy. Okay, the second strategy, once you've gotten past the planning piece, there might be some assumptions you might have to adjust or change. And one of those assumptions relates to the returns in your portfolio. So our basic operating assumptions for clients will be, don't take on more financial risk than is necessary for you to achieve the goals that you set out for yourself, but take on sufficient risk. Now, when we define risk, it's not loss of capital. It's not like putting money in a penny stock and then the company goes under and you'll never get your money back. So whenever you invest, you need to invest in high quality. So even in the stock market, if you're investing in high quality bank stocks or insurance companies or energy companies or dominant healthcare companies in the healthcare sector, mining companies, there are a lot of companies out there that are index heavyweights. They have pricing power, and over time, you're going to do well with those stocks in your portfolio. The bigger concern, though, is the short-term volatility, and that's what creates a lot of unease for people. But there's no doubt that as you begin to push in the direction of high-quality stocks, that is one of the ways that you can increase the probability that you're going to have legacy value there for your children or grandchildren by boosting the return. So the more conservative you are in the portfolio, then the less total return after taxes and after inflation you're going to achieve, and thus less legacy value that will be there for your family down the road. So let's take a look at just a few charts to illustrate the point. And again, this is not to say you have to buy stocks to create legacy, but it's one of the tools in your kit bag. And the financial planning that you do will confirm what part of your portfolio is needed for income, liquidity, and expenses. And is there a part of your portfolio you can push into higher growth investments to provide the potential for legacy down the road? Okay, so what you see on the screen is what's referred to as an index chart, and these charts have been around for a long time. And essentially what they do is they take a look at the major investment categories or asset classes and show you how they grow over time. So I'll zero in on some of these categories in a minute, but these lines show you the growth and over time how much money appreciates in value. If you put initially $100 in each of these major investment categories, what did they grow to? This chart happens to start in 1950, and I think the last year here is 2011. So it's just give you a broad sample. And again, the main purpose of showing this to you is just give you the sort of the big picture. How do different asset classes do over an extended period of time? So again, as you transition to retirement, you may not need access to your capital right away. You might have a 10-year or 15-year and sometimes a 20-year period on some of this capital. So let's take a look at these major asset class categories. The first thing I'll do is let's zero in on the different categories that this chart has. Okay, so again, at the bottom of this chart, we have things like 90-day T-bills in the green here. We've got 5-year GIC rates in this kind of orange color. We've got inflationary pressures as well, the CPI index. And I'll just show you how these more conservative categories, and we'll kind of use the 5-year GIC and 90-day T-bills as kind of a proxy. Let's take a look at that. So again, if we step back, here's what the chart looks like. So what we see is on this chart is that T-bills grew to about $2,900. 5-year GICs grew to about $5,900 as an example. And so these asset classes are at the bottom of the barrel in terms of total growth. If we go up further, we're taking a look at things like the Canadian stock market, which was not the best market to be in over this time period, but that $100 grew to basically $40,578. If we look at small cap stocks in the U.S., that $100 grew to $248,000, so just a crazy amount of growth. And if we look at the large cap index in the U.S., large cap stocks, the blue chips, we're looking at $60,150. So again, when you step back from this chart, again, the $100 that was invested compounded over that time period, and there's no doubt that growth or stock assets provided far superior overall growth to help you cope with inflation and taxes and to provide the potential for legacy value. The challenge to these asset classes is the volatility, and that's where portfolio design and asset management services can play a role in trying to mitigate some of those short-term risks. Now that can dilute the long-term growth, but I think for a lot of investors, what they want to do is try to tap into the return potential of equity markets, but try to employ strategies that will reduce some of the short-term risk. And Those could be the strategies like broad diversification, high quality assets, rebalancing the portfolio are just a few examples. So again, if you go to our show notes and this intrigues you a little bit, should I look at a portfolio that taps into the potential of growth? The show notes will take you back to our website. Reach out to us by email and we can start a conversation on that. Okay, let's look at the third strategy. So we've talked about how the financial plan, model your legacy planning goals, see whether those are achievable, what assumptions have to be adjusted. Maybe feather in some growth investments in the portfolio, and that can work for some investors, but not all. So let's look at the third strategy that could play a role for you. Well, the third strategy is put in place a life insurance policy. Yes, you heard it, life insurance. A lot of us have life insurance when we're raising our families, that if there's a catastrophic event and a primary breadwinner died prematurely, you want to have tax-free assets coming to the family to replace income. And that's the main reason we typically have insurance and think about insurance, particularly when our family is younger. We might have personal insurance, we might have group insurance. Group insurance typically ends when our career ends, when we retire. And personal insurance may continue, but it really depends on the kind of personal insurance you purchase. So if you've just purchased traditional term insurance, whether it's 5-year renewable term, 10-year renewable term, 20-year renewable term, eventually the term matures and gets so expensive down the road that either you just can't afford to renew it or it lapses. So most term insurance will not be renewable in past your early 70s. So it's not renewable usually past the time at which you're still living, and you'll probably live for many more years out to average life expectancy. So, term insurance for most insurance companies, that's the cash cow. It's like appetizers and desserts in a restaurant. That's where they make most of their money. The other kind of insurance is permanent life insurance, sometimes referred to as term to 100, universal life, permanent cash value insurance. I'm not going to get into the various topics, but a very elegant, simple way of installing legacy value in your estate planning is putting in place, if you're insurable, and that's a big if for some people, but putting in place a permanent life insurance policy. I know for my wife and I, we did that. We've got permanent life insurance. Now, one of the reasons we did it, and one of the reasons why I have many clients who have done it, is that by putting in place the permanent insurance, the premium will never change. It's locked in on the date in which you put it in place. You can also accelerate the payment so it gets paid up early. And that part of our financial plan is looked after. So no matter how we spend our other capital down the road when we retire, we know that that legacy plan for our children and grandchildren is put in place. We don't have to worry about it anymore. We've got a plan for that. So there's a real advantage to that, because other strategies like managing your cash flow and looking at your financial planning and the assumptions and maybe feathering in equity investments, all those things could still play a role, but they're not guaranteed as strategies, and life insurance is. Once you put it in place, you've been underwritten, insurance company's giving you the contract, it's in place permanently, and life insurance that's permanent in nature will last as long as you do, and upon death, it pays out a tax-free death benefit either directly to your beneficiaries, doesn't have to go through the estate, or it goes through your estate and then it's redirected to beneficiaries through the direction of your will. If I piqued your interest a little bit about the use of life insurance for legacy planning, don't hesitate again to go to the show notes. There's a link back to our website. There's a Contact Us tab. Just click on that. You can zip us a quick email. We can reach out and have a quick conversation about whether the strategy actually makes sense for you. Anyway, those are the main three areas. Have a plan. Look at diversifying your portfolio, and look at the potential for life insurance to put in place permanent legacy value. Hope you found that helpful. And again, if you're new to the channel, hit subscribe. If you want to find out more resources, some free educational content, or how you can get your complimentary retirement forecast, go to the show notes. There's links back to our website so you can find out more information about those various topic areas. Anyway, wishing you all the best in your retirement income planning journey and wealth planning goals. You take care. Bye-bye.